All right, welcome everyone. Today we're going to be taking a deep dive into the financial markets. After this crazy election, we've got some really interesting insights to unpack from sources like Bloomberg and Reuters, even some expert opinions. And, well, to put it simply, it's been a wild ride for the market. So we're going to try to break it all down and figure out, what does a Trump presidency actually mean for your investments?
Yeah, I think it's fascinating how these political events can really inject so much uncertainty into the markets. I mean, just look at the Nasdaq 100, right? It finally halted that 5-day slide, but Treasury yields, oh man, they're all over the place. And even Bitcoin, Bitcoin is rebounding. It seems like investors are just, I don't know, they're scrambling, trying to figure out what a Trump presidency means for everything, but especially the economy. And of course, everyone's wondering, what about the Fed's rate cutting campaign?
Yeah, it's definitely a lot to process. And Bloomberg actually pointed out that traders are laser focused on upcoming earnings, especially from companies like NVIDIA. So it sounds like, their performance could really be a bellwether for the market in the short term.
Yeah, absolutely. And I think that speaks to a broader point, right? When you've got all this uncertainty swirling around, the performance of individual companies can have a much bigger impact on market sentiment. But speaking of uncertainty, let's shift our focus over to the Bank of Japan for a second. They've decided to stick with their plan for potential rate hikes, and they're doing this even with, all the question marks hanging over U.S. economic policies right now.
Wow, that does seem pretty bold given all the unknowns out there. What's the reasoning behind that?
Well, from what I understand, BOJ Governor Ueda, he's basically saying, look, we've got to make decisions based on the data we have right now, not wait around for perfect clarity on what's going to happen with the US. And they're seeing the yen weaken against the dollar, which, that's not great for them. And a lot of it seems to be fueled by speculation about Trump's policies, especially those potential tariffs he keeps talking about.
So how does a weaker yen actually affect Japan's economy? And why would they even consider raising rates at a time like this?
So a weaker yen, it's actually a problem for Japan because it means the cost of imports goes up. And that can lead to, well, you guessed it, inflation. Some economists are even predicting that the BOJ might have to raise rates sooner than they plan just to try and keep inflation in check.
It sounds like Governor Ueda is in a tough spot. He's emphasizing, gradual monetary tightening, but he's also acknowledging that inflation could get out of control if they keep rates too low.
It's a classic central bank dilemma. They're always trying to balance domestic pressures with global economic forces. It's a delicate balancing act for sure.
Absolutely.
And here's something else to consider. This aggressive stance from the BOJ, it could actually benefit you if you're holding assets that are, denominated in dollars. Because as the yen weakens, your dollar-denominated assets become, well, relatively more valuable.
That's a really good point. I mean, it just shows how these, seemingly unrelated events happening on the other side of the world can have a direct impact on your portfolio.
Exactly. It's all connected. And get this. While the BOJ is leaning towards raising rates, the market seems to be interpreting Ueda's lack of a clear signal on, on the exact timing of those rate hikes as a reason for the yen to keep weakening against the dollar. Meanwhile, the dollar index itself, that's actually dipped slightly, and the euro is gaining some ground against the dollar.
It's amazing how the market reacts to even the slightest bit of uncertainty. Even expert opinions are all over the place, like Mark Chandler, for example. He suggests the market was hoping for a more concrete roadmap from the BOJ, something that Ueda's speech didn't really deliver. And then there's the whole question mark surrounding Trump's Treasury Secretary pick. Like, all this speculation is definitely adding to the uncertainty, and that's affecting how the market is behaving right now.
Yeah, no doubt about it. It's like everyone's waiting with bated breath to see how these pieces are going to fall into place. Okay, let's change gears a little bit and talk about inflation.
Okay, yeah, inflation's been a major concern for a while now. What's the latest on that front?
So the San Francisco Fed, they just released some new research, and, it suggests that the tight U.S. labor market is still a big factor in driving inflation. According to their findings, that elevated demand is still adding, a significant amount to the overall inflation rate.
So even with the Fed's recent rate cuts, we're still seeing upward pressure coming from the job market.
Yeah, exactly. It's making the Fed's job even harder because they're trying to walk this tightrope between controlling inflation and, supporting economic growth at the same time. And this research, well, it might make them think twice about cutting rates any further, especially if they're worried about inflation getting out of hand.
And it's not just the labor market that's, having an impact on inflation. The housing market's playing a role too, right? I mean,
Mhm.
the Cleveland Fed model is predicting that rent inflation won't ease up until like mid-2026. That's a long way off.
Yeah, it's definitely a challenge for policymakers because, well, they often use progress on inflation as a justification for lowering interest rates. But if rent inflation stays high, well, that just throws a wrench in the whole plan.
Omer Sharif, president of Inflation Insights, he even went so far as to say that cutting rates in the face of rising CPI inflation could lead to, even more disagreement among Fed officials.
Yeah, that definitely highlights the internal debates and challenges the Fed's facing right now. And here's another wrinkle to consider. There's this weird disconnect between what's happening with real-world rent data, which is showing some declines in certain areas, and then there's the CPI shelter inflation, which, well, it's staying stubbornly high.
That's confusing. Why is there such a difference between those two data points?
Well, it all comes down to, how the CPI is actually calculated, the methodology they use, combined with, the fact that people just aren't moving as much these days. It means that the CPI doesn't really reflect actual rent trends as quickly or accurately as the real world data. So for investors trying to figure out what's really going on in the housing market, well, it can be pretty misleading.
So basically, we're in this situation where the CPI might be painting a rosier picture of inflation than what's actually happening out there.
Yeah.
So how should we, as investors, how should we be interpreting all of this?
Well, it's a good reminder that we need to look beyond the headlines, right? We have to dig deeper into the underlying factors that are actually driving inflation. The housing market is just one example where things are, way more nuanced than they might seem at first glance. You've got to consider all the different forces at play and, draw your own conclusions.
Yeah, that's really helpful. And speaking of things being more nuanced than they appear, let's move on to the electric vehicle market, because it looks like there are some potential policy changes brewing that could really shake things up in that industry.
Oh, absolutely. There's a lot to unpack there, especially with all the debate surrounding the federal EV tax credit and how it might affect companies like Tesla, GM, and Ford.
All right, listeners, so we've covered a lot of ground here, from market reactions to the election to the BOJ stance to the complexities of inflation, but there's still a lot more to explore.
Yeah, the EV market is definitely it's kind of front and center right now, especially with all this talk about, how a Trump administration might change things. And one of the biggest, well, I guess you could say one of the most controversial issues is that federal EV tax credit.
Yeah, right. And it seems like, the experts are kind of divided on how removing that tax credit would actually play out.
Yeah.
Some people think Tesla could actually benefit from it, but traditional automakers might be in for a rough ride.
Yeah, it's an interesting dynamic for sure because, well, Tesla's already established itself as a profitable EV maker. But then you've got companies like GM and Ford who are still, they're still ramping up their EV production. And a lot of times they're doing it at a loss. If you take away that tax credit, it could put them at a real disadvantage.
But I mean, wouldn't removing those incentives slow down the whole transition to electric vehicles? I mean, isn't the goal to get everyone driving EVs eventually?
That's a good question. And it's a valid concern. I mean, if you make EVs less affordable for consumers by taking away those tax credits, it could definitely hurt the growth of the whole EV market. It kind of raises the question of, is it better to support the entire industry or should we just let the market decide who the winners and losers are going to be?
It's almost like a paradox, right? Like on one hand, you've got Tesla, who could potentially gain market share if their competitors are struggling. But then on the other hand, the overall EV market might shrink if consumer demand drops because of higher prices.
Exactly. It's a tough one. And to make things even more complicated, there's talk that consumer tax credits might get cut, but the manufacturing credits could stay in place for political reasons.
So we could end up with a situation where companies are being encouraged to make EVs, but consumers aren't really being encouraged to buy them. What would that mean for the traditional automakers like GM and Ford?
Well, it could push them back towards, producing more gas guzzlers and hybrids because, well, frankly, those are more profitable right now. And that would obviously be a step backwards for the push towards an all-electric future.
And that kind of ties in with what we were talking about earlier, with the potential for loosening fuel economy standards. It seems like we're at a real turning point here where the decisions that are made the next few years are going to have a huge impact on the U.S. auto industry and, on its role in the global EV market.
Absolutely. And Bloomberg NEF, but they actually revised their estimate for, for EV market share in 2030 downwards. And they're basically saying that if these policy changes go through, we could see millions of missing EV sales. It really just goes to show how much uncertainty there is surrounding the future of transportation in the US.
Yeah, it's a wake-up call for sure. I mean, the transition to an all-electric fleet is, well, it's definitely not a guarantee at this point. But speaking of policy changes, let's shift gears again and talk about the FCC. Specifically, Brendan Carr's appointment as chair by President Trump.
Right, and Carr's made it pretty clear that he wants to challenge big tech's influence, and that could have some pretty big implications for companies like SpaceX with their Starlink network and Amazon with their Kuiper project. And it's interesting because Carr has actually been a pretty vocal supporter of SpaceX in the past.
Yeah, but his stance on big tech goes way beyond just SpaceX, right? I mean, he's talked about everything from banning TikTok to like stripping companies like Alphabet and Meta of legal protections. He even wants them to contribute to federal internet subsidies.
He's definitely not afraid to shake things up, and he's particularly critical of big tech's content moderation practices. He thinks they're unfairly censoring certain viewpoints, and that these companies should be held accountable for their actions.
It sounds like his time at the FCC could be a real game changer for the tech industry. But I mean, won't he face some pushback from both big tech and traditional media outlets?
Oh, for sure. I mean, there are First Amendment issues to consider and potential conflicts with existing regulations. It'll be interesting to see how he handles those challenges and what the ultimate impact on the industry will be.
Okay, let's switch gears one more time and head back to the financial markets. I want to talk about corporate bond spreads because they've been making headlines lately. And S&P Global Ratings actually issued a warning about a potential bubble in this area.
Yeah, so for those who might not be familiar with the bond spreads, it's basically the difference in yield between corporate bonds and U.S. Treasury bonds.
And why is that a problem? I mean, why are these spreads something to be worried about?
Well, investment grade and high yield spreads, they've tightened significantly over treasuries. So basically, investors aren't demanding as much extra compensation for the risk of holding corporate debt. And that's raised some concerns that we might be in a bubble and that these spreads could widen really quickly. And if that happens, well, bond prices would fall.
So what's causing this trend? I mean, are there some fundamental factors that are supporting these narrow spreads, or is it just irrational exuberance?
Well, there are some positive factors at play in the credit markets right now. U.S. economic growth is still pretty strong and corporate earnings have been good. But S&P Global Ratings, they're worried that these low spreads might be, they might be masking the real strain on borrowing costs for some companies.
So the optimism that we're seeing in the market right now could be hiding some underlying risks. It sounds like something that investors need to pay close attention to.
Definitely. It's crucial to keep an eye on interest rate movements and any potential tariff increases, because those things could have a big impact on the bond market.
Okay, so we've talked about a lot of uncertainty in the markets today, right?
Mhm.
Driven by both political and economic factors. It can feel kind of overwhelming. How can our listeners, how can they make sense of all this and make smart decisions for their own portfolios?
Well, first of all, I think it's important to remember that investing is a marathon, not a sprint, right? Don't panic and make rash decisions based on short-term market fluctuations. Focus on building a solid investment strategy that aligns with your long-term financial goals.
Yeah, that's great advice. Don't get caught up in the hype or the fear. Make informed decisions based on sound research and a clear understanding of your own risk tolerance. Yeah, it seems like everywhere you look, there's a potential bubble or some kind of policy shift that's about to happen. It's definitely a lot to keep track of.
It really is, and it underscores how important it is to stay informed and to be adaptable as an investor. The
Mhm.
landscape is constantly shifting, right? So you got to be ready to adjust your strategy when the time comes.
So we've taken a deep dive into market reactions, potential policy changes. We even touched on some potential economic bubbles. But what does all this mean for our listener? Like, what are the key takeaways here that they should be thinking about as they try to navigate this uncertain environment?
Well, I think the biggest takeaway is that we're in a period of real transition, right? A new presidential administration. While it always brings changes. In the financial markets, they're just trying to, they're trying to adjust to those changes in real time.
And we've seen how those changes are impacting, everything from tech stocks to the Japanese yen to the EV market. It's all tied to the election results and those potential policy shifts that might be coming down the pipeline.
Yeah, it's all interconnected, right? Decisions made in Washington, they can have ripple effects throughout the global economy, and those effects, they can impact your investments, your job, even the price of groceries at the supermarket.
So it's not just about watching the stock ticker all day long. It's about understanding the bigger picture
Yeah.
and thinking critically about how these global shifts could create opportunities or challenges down the road.
Exactly, exactly. Like, for example, if the US does decide to slow down its transition to electric vehicles, what does that mean for other industries, like renewable energy or infrastructure? These are the kinds of questions that investors need to be asking themselves.
Yeah, that's a great point. It's not just about reacting to the headlines. It's about connecting the dots and thinking long term. So what advice would you give to someone who's maybe feeling a little overwhelmed by all of this information and uncertainty?
Well, first of all, don't panic. It's easy to get caught up in fear or the hype, but remember, investing is a long game. And second, stay informed, right? Keep up with the news from reputable sources and make sure you're getting your information from a variety of different places. Don't just rely on one perspective.
Like the old saying, don't put all your eggs in one basket.
Exactly, exactly. And finally, don't be afraid to reach out to a financial advisor. They can help you develop a personalized investment strategy that fits your risk tolerance and your financial goals.
Yeah, sometimes it helps to have a professional in your corner who can give you that objective perspective. Well, we've covered a lot of ground today, from the stock market to interest rates, housing, EVs, even the FCC. It's been a whirlwind of information for sure.
It's a complex and dynamic landscape, no doubt. But hopefully this deep dive has it's given you a better understanding of the forces that are at play and empowered you to make smarter financial decisions.
Remember, knowledge is power. The more you understand about the world around you, the better prepared you'll be to weather any storm and maybe even take advantage of new opportunities as they come up. Thanks for joining us on this deep dive. Stay curious, stay informed, and as always, thanks for listening.